Hello, my name's Charles Lastic. I'm the Managing Director of Blue Bond Tax Planning. I've been an inheritance tax specialist for more than 18 years and have helped hundreds of clients save millions of pounds on their inheritance tax planning and implementation. So today's video is around family investment companies. What are they, and should you consider setting one up for your inheritance tax planning? Hi and welcome back. So today's video is around family investment companies. What are they, and should you consider setting one up? So in essence, a family investment company is the same as any other limited company for taxation once it is actually set up. So the difference is in the inception and how it's set up in the first place. Now, normally speaking, you could get your accountant to set you up a limited company for anything £400-500 or whatever that they would charge you to do that, and you could do it cheaper if you did it yourself. But those companies all use standard articles of association and memorandum on the setup, and those are actually the rules of how the company operates. So when you set up a family investment company, you set up different rules. That's the point. It's the rules that change, and those different rules allow you to do things differently. So one of the major things that it allows you to do is that you would set up something called an entrenched directorship, which basically says that irrelevant of who owns the capital shares of the company, you can remain as a director of the company as long as you live. If you're a director, then you can control the assets in that company, and more importantly, you can control the dividends that come out of that company from the profits, which you can pay to yourself even if you don't own any capital shares and you just own income shares. The other major benefit is that alphabet shares can be set up. So the parents would normally, who are setting this up, would have A and B shares, for instance, and their children have C, D and E income shares, and therefore you can do different dividends to different children. So HMRC don't like this in open companies because obviously it means that a lot of tax can be avoided, but in a closed company, which is what a family investment company is, because one of the other rules would be is that only the people setting it up, husband and wife, and their children and their grandchildren, their bloodline, are the only people who are allowed to own shares. So spouses of children and grandchildren are not allowed under the rules of the company to own shares. That has some significant benefits in terms of protection of the assets, and you could watch a couple of my other videos on family investment companies around that. So the main difference is, and why should you do it and who should do it? Basically, if you've got more than $1 million in investments and you're single, or you got more than 1.5 to 2 million if you're a married couple and you want to place money outside of your estate and you're not going to live more than 14 years, in other words, you only get one go at trusts, which the most you can put in is 650 as a married couple, then a family investment company may suit you. If you've got more than 6 properties, then also putting your properties into a family investment company may suit you. But watch my videos on those two scenarios. One is called Should Landlords Use a Family Investment Company? Okay, so that's family investment companies, a short video on it, but you know, again, it's quite a complex thing. So if you're interested, give us a call and let's see how we can help. So hopefully you found that interesting. If you did, please give us a thumbs up and a like. It would be appreciated. And thanks for listening, and bye for now. Bye.